Welcome back. You're still tuned into Markets at Noon right here on ET Now. We are at the fag end of the earnings season and it has been a soft earnings season so far. And remember, India continues to trade at muted valuations, in fact, expensive valuations as compared to the rest of the world. But what is the market setup looking like from a fundamental perspective? To discuss this, we now have Jigar Mistry, co-founder at Buoyant Capital, now joining us. Mr. Mistry, afternoon, and thank you so much for taking your time out and joining us here today. Take us through your assessment of how earnings season for the second quarter has been, and any key takeaways, any sector that you're now turning bullish on after the kind of results that they've reported?
Hi, good afternoon. Thank you as always for inviting me to your show. So I think, the result season I don't think is picking up yet. So first quarter we saw about 7% growth in earnings, which arguably was on a much weaker base. April, May, June 24 was the peak of the election seasons, right? And on that base, if you're growing at 7%, 2Q you didn't have a lot of expectation getting into it, especially also given the fact that there was a 1 month lag between GST announcement and sort of it getting effective, and one of a 3 month period is a fairly long time. So there was not a lot of expectations getting into it, but I still think we are growing in sort of low single digits, which is not great. The genesis of this, however, I think lies sort of in the way in which policy level transformation has happened in India. We are moving a lot more sort of consumption specific rather than capex intensive, and that is starting to take its toll. And also, what happened around September, October 2024, when the RBI had to sort of sell almost $100 billion in the NDF market to protect the rupee. And I think that created a negative impetus on the domestic liquidity, which is now playing out. Our sense is that starting third Q, the results of which will be known by January, we'll start seeing things improve a little bit. And I think the most of it will get clearer around fourth quarter numbers. Within the sort of, to answer your second question, within the sort of what we are seeing, I think we're still seeing tepid consumption details. We're still seeing tepid, discretionary spends. There's some places where things are better than others, but overall, I think it still continues to be lackluster.
Right, Mr. Mistry, this is Ankita also joining in. Couple of things that you mentioned there, that you still haven't seen any pickup in consumption or discretionary spends for that matter, except a few pockets that you mentioned. But as I can see in your portfolio, you're overweight on the banking sector. Banks are, have been the safe haven or the, sector that has been holding the fort. But besides that, what are the sectors that you're bullish on? Consumption, one was expecting consumption to revive, a re-rating in the consumption pack because of the GST rate rationalization and so on, and the consumption to pick up. But as you mentioned, that the consumption has also been very tepid.
Right. So, your total what's actually been handed out, and the 16 states that went into elections recently, we looked at what they have pronounced as a sort of pre-poll freebie. And if you total all of those announcements, that number is higher than the total capex bill of the states. The center has also let go of almost 1 lakh crore in income taxes and 2 lakh crores in lower GST. So when you sort of total all the three numbers, you're talking about almost 5 lakh crores or 1.4% of annual GDP of India being transferred into the hands of people at various levels of income of housing. In that scheme of things, different sects benefit. We don't think people will go on and buy more soap or oils, but I think they'll get into very sort of non-discrete consumption items. So travel, leisure, those things become sort of the center stage. Cement we see as a part of a discretionary spend because 70% of cement sold by volume goes to individual home builders, and a lot of money has been transferred to these people. Lastly, you can also play this through sort of really discretionary consumption, like big ticket items like two-wheelers. So those are the sectors where we had incrementally put in some exposure. Banking, in fact, it looks like a large exposure, but our sense is that we have trimmed some of it because getting into September 24 cycle, we were extremely sort of positive and overweight the way you put it. We don't see it relative to index, but we had a very large exposure to the banking sector. We thought the investors were a little bit circumspect, expecting the NIM cut to be much stronger. We were not completely in sync with that line of thought, and the valuations continued to remain attractive. The last point I'll mention here is that when we talk banking, the weight are predominantly favoring a couple of banks, but a lot of value over the past 4 or 5 years have been created outside those banks. So I think it stands to reason that you can still make a reasonably active bet while continuing to have the same sectoral bet.
Valuation for the banking sector continues to remain very attractive. But Mr. Mistry, also wanted your thoughts on the action that we are seeing in the primary market. Lenskart got listed today at a discount of about 9%, although it has recovered after that. Valuation was a concern. Had you participated in that IPO? And in general, your thoughts on the entire primary market action that we are seeing?
It's a bit tricky, to answer your questions. We weren't on this in this name, but see, there is sort of a place where you keep arguing that there is a very large total addressable market, and there are ways to sort of look at those. You can always argue the valuations at which these are offered, at least to a fund like us. We are value conscious. It doesn't make a lot of appealing sense to us. At the same time, these businesses get sort of listed at valuations, which, if history is any guide, don't really hold up across cycles. So it remains to be seen. They've built a good business, no doubt about it. Remains to be seen sort of where the valuation ends up at in a few days. But to answer your question, no, we're not part of this listing at all.
All right, so you're not a part of the Lenskart listing, but Mr. Mistry, talked about the broader market, because I know you are heavyweight on the large caps, but what about the broader end of the market, the small and the large caps, the small and the mid caps? There has been considerable correction. Do you still see the valuations to be frothy there, or there's any other sector where you find value as far as the broader end of the market is concerned?
So I think, see, given sort of the external scenario we have, A, the results not panning out as expected, A, and B, the tariff issue not completely resolved as far as India is concerned, one would have expected the markets to tread a lot lower had it not been for the very strong flows. Flows can you bucket in two parts. One, FIIs continue to exit. October was a decent month. I think we saw an inflow, but overall there's still, I think, $17 odd billion sort of sales from India. Now, this is interesting because, the dollar, as you measure through a DXY index, has depreciated from 110 to 98. I think it's returned back closer to 100, but it has depreciated. And every time dollar depreciates, money moves into emerging markets. It came to emerging markets but eluded India because rupee depreciated on a depreciating dollar. Right? So essentially, given high valuations and the rupee sort of depreciation, FIIs are not fully convinced about investing in India yet. But domestic money is coming in droves. By our track, the last 12 months is roughly $60 odd billion, which is massive given the history. But we are still 5.6% of the household savings coming into equities, which is far cry from the 0.7% we were a decade ago. But most developed markets are upwards of 20%. USA is upwards of 40%. So if you pencil in a 10% number, a couple of years down the line, you're talking about more than doubling of domestic money, and which keeps sort of the small and mid caps sort of a little more resilient than what we would have expected were we to increase exposure dramatically.
Right. So FIIs are still not convinced about investing in India. That's the word coming in. Mr. Mistry, thank you so much for taking your time out and joining us here today on ET Now and helping us understand what the fundamental market outlook is going forward. Thanks so much for joining us today. On that note, we need to slip into a very short break, but many more managements joining us on the other side. Don't go anywhere.
Motorola